template you can just see for the guidance, okay? And then as a group of 2, they are about 20 odd students, isn't it? So a group of 3, there will be an assignment where you have to choose your own companies, okay? So I have chosen all the cement companies, okay? So you have to choose, either IT companies or FMCG companies or whatever industry, same industry, okay? Fine. Then you have to fill up everything and make a presentation. Yeah, just a sec. So then you have to make a presentation after submitting your assignment, which will be around 50% marks. 50% will be on your own performance, which you will be sharing, okay, as a presentation. Okay, fine. So what was this thing? So I'll be sharing that whole, what you have to do. Okay, fine. Yeah. I'm going to tell everything, so don't worry. I'm going to, give you a complete picture. Okay, fine. And so this is the template. Okay. Once you complete this template and analyze all the companies, then you can know, how the companies are doing, which companies are good, where to put your money. Like this, you can do for any set of companies and understand whether the companies are worth buying. Are they rightly priced? Okay. Fine. So it will give you a lot of understanding about the companies. Now, one of the purpose of this exercise in our course is this. So I'm just going to open another first I'll take you through a presentation. Okay, which is the examples. So I was covering examples, okay, last time. So I'm just going to, cover one relevant examples here. Okay. Now, there are certain companies which are not listed on the stock exchange, okay. Those companies which are coming for an IPO, they are not, already listed on the stock exchange. So they have to decide at what price they are going to issue their shares. Okay, either they have a track record or they don't have any track record. They are absolutely companies which are brand new with no business background at the back. So they are going to raise money from the people and start their companies. Very few companies like that. Some companies, they are already in business, track record about couple of years, and then they come up with an idea of coming with an IPO to basically they want to expand their footprint. Now, one of the companies which I worked was that time the company name was Idea Cellular, and now it is known as Vodafone Idea. So in 2007, after running the company for about 10 years, it was owned by Tata's, Birla and AT&T. It was a very big company those days, and so Tata's, Birla's and AT&T, they were equal owners of the company. They were already having 33% stake in the company. So they decided that they have to now make, have a broader footprint. They should be pan-India present. So they needed a lot of money to expand their operations. So they came with an IPO. Okay. So the company was already worth about 10,000 crores in terms of valuation. Okay. They were already operating in many places in India, 5 places like Delhi, Maharashtra, Gujarat somewhere, and some more places. I'm just forgetting this thing. Otherwise, those places used to be in my tips when I was working. So all those companies who come and issue shares, at least for the first time, and they are not listed in the stock exchange, they want to know what price they should offer their shares. Okay, and the merchant bankers always help them to decide about how much premium they are going to charge to the shareholders, because the new shareholders come, they'll become the owners of the company, and they will have equal rights on the assets and liabilities. So the company, if it is worth 10,000 crores already, so the existing shareholders will not like to give them shares at 10 rupees. So they're going to charge at premium, so that they pay premium and they can enter the company, and then they will have a proportionate right on assets and liabilities of the company, and they will earn the profits on the basis of their share in the equity shares. Okay, so this is one of this thing where you can understand how to value an unlisted company. Okay. Now, even for a company which is listed already and they are coming with an FPO, that means they are already listed and they want to subsequently issue shares. As I told you, the share price which is there in the stock exchange is not the intrinsic value of the share. It may be either overpriced or underpriced depending upon the situation in the market. Okay, so they would also like to know that how much they should charge from the prospective shareholders. So it is both for the companies which are not listed on the stock exchange and the companies which are already listed. So they would like to know what price they should charge. Okay, so they seek the advice of the merchant bankers or the investment bankers, and they help them to tell what is the right price of the share. Okay, of course there are two kind of major mechanisms how to value a company. One is called the relative valuation, which we are in the process of learning, and the second is called the DCF technique, which is which calculates the intrinsic value of the share of the company. Okay, which calculates what should be the real worth of the company. But relative valuation has a flaw that it values the company on the basis of the market mood. If the market is very optimistic and it's already highly priced, so it will throw up a higher price. If the market is pessimistic and it has declined a lot, so when you value a company, its share price will come very less. So it is not the actual price. So then now you know what should be the price. At least you have some range to deal with, and then you can also calculate your share on the basis of intrinsic method. Okay, fine. So we'll briefly touch that later on, but it is not part of our understanding at the moment. Okay, so let's understand. Shrishti, can you read?
Same sector.
Okay. Yeah. Suppose ABC Food Limited is there was some other thing also along with it. कुछ गिरा था? The magnet. Just have a look. There was some magnet which gets attached with it. Come. It might have fallen. Okay, we'll search it after some time. Okay, just take your seats. So suppose ABC Food Limited is an unlisted FMCG company. Okay, a fast-moving consumer goods operating primarily in a snacks and beverages. You want to estimate the equity value based on listed peers on the same sector. Okay, so which means that you have to value this company based on already listed companies in India. Okay. Now, what you are supposed to read, these are the steps. Okay, just read.
Step 1, select listed comparable companies, big companies that are in the same sector, FMCG, snacks, beverages, of similar size of business model, not giants like ITC or HUL that are too large, are public financials trade on the Indian stock exchange.
Okay, so now you are looking for comparable companies. Okay. But all these companies which we have talked about are the company which is unlisted companies and FMCG company. Okay, so you will look for similar size companies. Okay, not a company like ITC or HUL because they are too large. Okay, so then have public financials and trade on Indian stock exchange. So they are trading on the Indian stock exchange. So then you found there were 4 companies. Okay, which were a smaller companies comparable to HUL or ITC, like Pratap Snacks, Hatson Agro, DFM Foods, and Mrs. Bector Food. Okay, Mrs. Bector Food is very well known now. It's already come with an IPO. It's that brown bread. We take our Kramica biscuits. Okay. Fine. So it sells biscuits and bakery products, and it also supplies burger buns to McDonald's and KFCs and everything. Okay, so it's doing a huge business now. So then you found out what were the financials of this company. So gather the financials and multiples. So Pratap Snacks, Hudson Agro, and Mrs. Bector. So we have the financials of these 4 companies, okay, or 3 companies. So Pratap Snacks is about 1600 crores of revenue, and Hudson Agro 7,000 crores. If you look now, it is around 8,000 crores. Mrs. Bector 1100 crores of revenue at the time when this was done, and they were making some profits. EBITDA of 160 crores, 560 crores, and 130 crores respectively. Then they were PAT positive, 70 crores profit Pratap Snacks, 200 crores Hudson Agro, Mrs. Bector 60 crores. So they're all profitable companies. And if you look at the multiples, these are called the valuation multiples, or how the companies are valued. So EV to EBITDA is 18x, okay, for Pratap Snacks. For Hudson Agro, it is 22x. For Mrs. Bector, it is 16x. Now, if you see this list, which is the cheapest company according to you? Ishani? EV upon EBITDA. When you look at EV to EBITDA, which is the cheapest company? Of course, the company which is having the lower multiple. Because this company is trading 16 times than its enterprise value. Okay? And whereas Hudson Agro is trading 22 times over its enterprise value. Okay? And Pratap Snack is trading at 18x compared to its enterprise value. And enterprise value is nothing but what? Shrishti? What is enterprise value?
So enterprise value is market cap plus debt plus
Minus cash. So it is basically, what we are trying to do. I mean, of course, that's a formula like market cap plus the debt minus the excess cash. Now, it tells you what? It throws out, what is the operational, how many operational assets the company has. Because everything is financed either through debt or equity. So this figure captures how the company has, what is the market value of all the operating assets of the company from which it is doing business. That's why we minus cash, because that cash which is excess sitting in the company is not being used for running the business. So it has been parked as an investment till the company finds time to put it in somewhere into the business, okay, by buying new, equipment or whatever, expanding their business. So that's why the cash is minus. Is that okay? So what is enterprise value? Ranjana? Ranjana is your name? Mahalakshmi. Mahalakshmi. Okay. So speak in English, not in Tamil. Okay, fine. Okay. So you are from Chennai, yeah? So EV to EBITDA, basically, if you look at, you will find that Mrs. Bector is priced at 16 to its enterprise value, isn't it? Okay. So it's the cheapest. Then price earning ratio. Now, as per price earning ratio, which is the company which is cheapest? Yeah. What's your name? Aapka kya naam hai? Harshita, yeah. Which is the cheapest company out of these 3 trading in the market? Lowest, because it is trading at, Mrs. Bector is trading at 36, 38 times than its earning EPS. Okay. So this is, priced 36 times over its earning price per share. Okay. So that's the cheapest, because all other are trading higher price. So higher the multiple, higher the value of the companies. It is trading at a higher value compared to the other companies. Is that okay? Lower the valuation multiple, the company is cheaper. Whether you look at any multiple, whether it is, EV to EBITDA, whether it's EV price to earning, or it is EV to sales. When you look at EV to sales, then which is the company there? Which is the cheapest? What's your name? Madhav. Yeah. Which is the cheapest company in terms of EV to sales? Mrs. Bector, yeah. So again, Mrs. Bector seems to be the cheapest among all the companies, isn't it? Fine. So have you got the lower the multiple, the cheaper the company? Okay? Fine. So, first principle is, suppose you are making an investment. Forget about here, you are trying to value a company which is not listed. But when you are looking at a multiple, you look at the multiple which is the lowest. Okay? Then you say this is the cheapest. whether you want to buy the share or whether you want to buy a company as a whole. And in case of merger and acquisitions, many companies, they look for buying other companies. So they will look at these multiples to find out which is the cheapest one, so that they can, they can offer certain price to the shareholders of this company and buy that company. If they find all the companies are good, then all our companies are equally, doing well, they have a good future. So then the cheapest becomes, the lowest multiple becomes basically a better choice to find out which company is better. Okay. Now companies may be trading at a higher multiples or lower multiple depending upon their future growth. The more the growth, higher will be the multiple. Okay. But if the multiple has gone up and the growth has come down, then we say that the share is overpriced. We should not buy it. Okay. Fine. So sometimes the multiple goes up and the company is not doing so good. Like, recent cases of Hindustan Unilever. It was trading at a very high, multiple of about 70, 80, 90. But now the growth prospects of Hindustan Liver are not that great as what it used to be. Of course, we have the GST coming. Now it's going to lower, and then, it will affect positively to the Hindustan Liver also, and their growth will become better compared to what they have done in the last 2 years. Is that clear? Any questions here, please? Have you followed? Now, what you have to do is, the second step, first is basically find out all the comparable companies, then find out all the financials, the relevant financials, and the third is calculate the average multiples. Okay, and we always calculate the median multiples. Okay, fine. Exclude the outliers and calculate the average. Now here only the three companies I think we have calculated the simple average. Okay, fine. So EV to EBITDA is about 18.7 for all the three companies if you take a average. Okay, but when we calculate the P ratios, all these companies are trading around a multiple of 41 on an average, and EV to sales is about 2x. Okay. Now, why there are so many multiples? Because, as I told you, so there are some positives and negatives to each multiple. Okay, they are all good, but there are certain, negatives attached to certain multiples. Like, for example, EV to sales. This multiple is normally used for companies which are doing sales but making no profit. Then you have to use this multiple. Okay, because company is not EBITDA positive, neither it is earning positive. So we have to rely upon EV upon sales. The new companies, okay, companies that just started their businesses. Second, they say that EV to sales is more better multiple because the sales cannot be manipulated so much rather than the profit of the company by the accountants, because the top line. Okay, fine. So when you ask two accountants to prepare and calculate a profit of the same company, they will come up with some different numbers. Okay, because both using different accounting principles and practices, which are valid ones. Okay, like some may use a written down value method for depreciating the assets, some may use a straight line method, somebody use FIFO, somebody use LIFO. So there are a lot of hands, some accounting principles which can be used by different accountants to come out with profits. Okay, come. You are in this class? Yeah. So once you have calculated the average multiple, then you look at the financials of the company which is not listed. The revenue of the company is given, EBITDA of the company is given, and PAT of the company is given. This is the ABC company financials. Okay, fine. So they are making a revenue of about 300 crores, EBITDA of 40 crores, and PAT 15 crores. I hope you all understand EBITDA and PAT. EBITDA is earning before depreciation, interest, depreciation, and amortization. So it's a cash profit of the company. So if you want to know how much cash the profit company is generating, the EBITDA becomes a proxy to the cash. Okay, fine. Or it's almost like operating cash profit of the company. Okay. Then the PAT, which is the ultimate profit belonging to the shareholders. Then apply the valuation multiples. Okay. Now, when you apply the first multiple using EV upon EBITDA, so you find EV is 40 crores for ABC. And the average multiple is 18.7 for the peer companies. So we came up with a valuation of 748 crores of this company. Okay, fine. So the enterprise value of this company would be 748 crores. Okay, fine. By simply taking the average of all the listed peers and applying, and we know that the EBITDA is EV upon EBITDA is 18.7, and 14 crores is what? 40 crores is basically the EBITDA. Okay, so 40 crores multiplied by 18.7, so we get the enterprise value. Is that clear? Then using P multiples, so we'll get a different valuation. Okay, so here the net profit is 15 crores multiplied by 41, so we get 615 crores. Okay, fine. Now remember, EV includes debt and equity value doesn't include debt, so we have to make some adjustments to make it comparable. Okay, then EV upon sales, which is basically 300 crores the revenue multiplied by 2, which is the EV upon this thing, sales multiple. So the value comes to 600 crores. So we have got three values: 748, 615 and 600. So that means this is ranging from 600 to 750 crores. All these are within the range of 600 to. Now assume that the debt of the company is 50 crores of the unlisted company. They have taken a debt of 50. Now we can calculate the equity value, which is, which will be in the range of 650 to 700, because how much? Okay. So it will be between the range of 550 to 700, because if you look back here, so what is the enterprise value? 748. Look at the enterprise value using EV to sales, 600. So it is ranging from 600 to 748. And we are going to minus 50 crores of debt. So we'll come to the equity value, isn't it? So 600 crore में से 50 crore गया तो 550 रह गया, 748 में 54 गया तो 698 रह गया. So that means 500 to 700 crore is the valuation, enterprise valuation of this company. Is that okay? Have you got it? Have you got it? Okay. So anyway, I'll just show the full calculation again. Just read these key points and then we'll just check the calculations also here. Okay, just read all of you in your mind. If you have any question, choose the industry relevant size, comparable listed peers, use multiples like EV to EBITDA, P and EV to sales, adjust for the debt to get the equity value, because the EV multiples will give you the enterprise value. So you have to minus the debt to arrive at the equity value. Then only compare the value which you have come through the P ratio, because P ratio is simply giving you the equity value. All other multiples are actually throwing you the EBITDA, the EV value. Okay. Okay. Use the average. Fine. So then you have to make an average. Read.
Cross-check with multiple metrics calculation means using more than one valuation multiple, like EV by EBITDA, PE, and EV by sales, to ensure your final valuation estimate is reasonable and consistent.
Okay. Now you are using three multiples here to value a company. So normally you are advised to use couple of multiples to arrive at the value. Okay. Now you will not get a fixed price. When you are going to buy asset, suppose you are going to buy a house, so you'll say that this is in the range of 13 to 14 crores rupees, or say 10 to 12 crores, or 2 crores to 2.5 crores. Okay, fine. So a range will be given to you, and then you can go and negotiate with the company, or how much you would like. Suppose you are going to acquire another company, so you know what is the range. Okay, do you want to buy this company as a whole? So you'll come to know the range, all possible range at which this company can be either bought or sold. Okay. Okay. Now we'll come back to this slide here. So EV upon EBITDA, which is 748 minus 50 crores, so we get equity value of 698 crores. Okay. If you look at the price earning ratio, it gives you 15 crores into 41, so 615 crores. Straight away you get the equity value. But if you want to calculate the EV upon sales, 2x multiple, then it is 300 crore into 2, so it gives you 600 crores enterprise valuation, minus 50, so you will get 550 crores. So if you, ultimately you are interested in the equity value, isn't it? Fine, because you are going to buy the equity as an investor, or as a, if you're doing, you want to buy a company as a whole. So it gives you a value of 698 crores when you use EV to EBITDA. It gives you a value of 615 crores when you are using a pure P multiple. But when you are using EV to sales, it gives you 550K. So that means the spread is between 550 to 698. So that's a kind of a range. The company can be bought either close to 550 crores or within the range of up to 700 crores. So there's 150 crores, gap which has been given by that. Then you will read this basically, what is applicable to your company, the value will be much closer to based on this. Okay. So P ratio, which is, best for mature company with stable earnings. Okay. So if the company is mature and stable, then the value thrown by the P multiple should be most ideal one. EV to EBITDA, it is basically operating cash flow before debt and tax. Neutral to capital structure differences. So here basically you are taking out the impact of the debt. Because if you have more and more debt, okay, and we know that debt is cheaper compared to equity, and it will push up the valuation of the company because it will have a leverage impact on the equity valuation. Okay. So if you want that I should calculate my value on EV to EBITDA basis, which is the right method, takes out the impact of leverage. Okay. Then EV to EBITDA is a better method. I'll explain this again if you have not followed what is leverage. Have you followed what is leverage? Leverage samajh aa gaya? Have you followed, Mahalakshmi? I have explained this in my class and you can always, go through the video. I'll explain again once more for all the benefit because some students were not there. Then we have EV to sales. So early stage or low profit firms. So if your company is an early stage company, it's a startup, then EV to sales gives you a better handle on how to value the company. But you are missing the profits. So it has a drawback here because it's not capturing the profitability of the company. You are trying to value on the basis of sales. Okay. So there is no fixed mechanism through which you can calculate, but you can have a kind of a range. Okay. And then you can always negotiate hard because you are going to buy the company as such. So, whatever is applicable, you should use that. Now, coming back to the leverage. In one of the class I told you, it's the debt which is cheaper and equity is costlier. Because when you put your money into business, you expect a higher returns. But when you give the same money in form of a debt to someone, like when you give the money to the bank as a fixed deposit, how much you earn in a fixed deposit? 7%. And you're happy with that. But when you give the same money to a company as an equity, you will have a risk that you may lose entire money. So your expectation would be around 15-20% kind of return as against a 7% return from a fixed deposit. So equity is costlier compared to debt. Equity, there is a risk also of losing the entire money. In debt, the risk is less, return is also less, and you're happy with that. So equity is costlier, debt is cheaper. One reason is this. Second is the debt is actually what? What is the second reason for the debt being cheaper, Srishti? Why the debt is cheaper? Anyone? Just raise your hand and tell me the one number. Yeah. It is? It has a tax benefit, you said. No. If I heard correctly. No. There is a tax benefit. Because debt, when you take debt, when you borrow money, you have to pay interest. And interest becomes your expense. For the company, it's an expense. Company will show that expense in their income statement and calculate the profit and pay the tax after that. It is tax deductible. It is what? Tax deductible. Okay. Whereas, if you have taken money on equity, so what is the counterpart of interest? The dividend. So when you pay dividend is an appropriation of profit. It is not an expense for the company. So the company will not get any benefit for paying dividends. So their tax liability will not go down because it is shown below the line. It is shown in profit loss appropriation account if you are done in your school. Okay. So the interest is taxable. Okay. So interest is taxable and company's cost comes down compared to the equity. So that is cheaper. So that's why when we say that there is a formula called KD, which is cost of debt, which is interest 1 minus t. Have you seen this formula in your life? 1 minus t. Because if you are paying 30% tax, then suppose you are paying say 10% interest on your loan and your tax is 30%. So for the company it is just 7%. Okay. For company, the cost of the company is only 7%. 1 minus t. Have you got it? आप तो कहते हैं लेवल मुझे पता था, but you are not able to. You're not a professor, you can't just teach. Okay? Anyway, is that okay? Can you see that? What is written there?
Yeah.
So, the debt is cheaper. Which is cheaper, debt or equity? Debt. Now, when the debt is cheaper, companies deploy debt because they know that debt is cheaper. Okay? In good times, it will reward magnificently, it will magnify the profits of the company. Suppose the company is making 20% return on the total capital and it's just paying 7% to the equity, to the debt holders. So the remaining 13% is captured by the equity shareholders and their profits go up. The earning per share multiplies. Okay, fine. So it has a leverage impact. For better understanding, watch my video which I have just shown under this thing, the last couple of lectures, which I have given a complete example to show that. So debt, the company is giving only 7% after the cost of the tax, okay, and company is earning 20% on the capital, whether it is being raised from debt or from equity. So that means the equity shareholders are going to benefit out of the lower cost of capital. But in the same time, if the company sales drop and their return on the capital drops, then the company is going to suffer badly and the money will be paid out of the equity shareholders' capital. If suppose the company is making just 2% profit, okay, instead of 15% or 20%, earlier example. So what happens? It has to pay 7%, and that 5% which is paying extra goes out of the pockets of the shareholders, and their earning per share will go down, and the share price will also fall in the market. So it is riskier to have more and more debt. If you feel that the company is going to do well in next 3 years, borrow money. But if you think the company is going to pass through a very bad phase, okay, or the world is going to have not good future, okay, because of whatever reasons, so better stay away from the debt and limit yourself to a less of equity, of debt. Okay, so most of the company want to remain debt free just because of this reason. They don't want ups and downs in their profits. Okay, so now coming back to this template. So you have to fill up this template, okay?